Energy prices have been soaring lately. How soon until they come down again? Will they come down again?
That we've gotten used to relatively low energy prices for the last 4 or 5 years, and that secular period of oversupply is over.
Welcome to Wealthion. I'm Adam Taggart, founder of Wealthion, here with an important interview on an especially timely topic. We've all seen energy prices skyrocket over the past year. For the fuels that we heat our homes with, the electricity we use, and the gasoline we put in our cars. And certain parts of the world have been concerned about simply getting enough energy, at whatever the price, to see them through the winter. Why did energy suddenly become so in demand? And how did it get so expensive so quickly? For the answers, we turn to energy expert and petroleum geologist Art Berman. Art, thanks so much for joining us today.
And Happy New Year to you, Adam. It's always a pleasure to talk to you.
It's always great to talk to you, Art. Thank you for being one of our first guests of the new year here, and a very relevant one. So, as I just mentioned, I think a lot of people were caught by surprise with how forcibly energy has come to the forefront over the past couple of months. And I'd like to dig into the causes of that for you with you. Now, just quickly looking at oil and gas prices before you came on here, oil is more or less doubled over the past year. It's almost a double. And natural gas back in October was like a triple for the year. It's come down a bit. It's still about a double, though. So what dynamics are driving these extreme price increases?
Right. So, first of all, for listeners that are not particularly into crude oil and natural gas, um, I understand that, and the reason that we're going to start with oil is because oil really is the economy. Oil is the master resource of everything that we do and use, and we can discuss that in more detail if you like. So, if you want to understand the price of anything, if you want to understand inflation rates, you want to understand just about anything that economists worry about and talk about, and almost never mention natural resources. I try to take them back to oil. It's not the only cause of things, but it's usually one of the top two or three. So, to your question, first of all, you said that oil doubled from about 40 to to low 80s. That we're talking about U.S. oil prices, West Texas Intermediate, all of that. You want to know Brent, add $3 or $4 to it, international prices. So 40 is way underpriced, and so a double means we're going from some deeply discounted price because of COVID. And for those who know, I mean, actually prices got a whole lot lower than that for a while, but $40 is just anomalously low. And so really what we want to be talking about is 65 to where it is now, which is about 85, let's just say in round numbers. So that's a healthy increase. Um, the reason, there are many, but the main reason, if you had to say, is that OPEC and their friends, so-called OPEC Plus, were withholding 10 million barrels a day from the market for all of 2020, just about, and are still withholding, a considerable amount. And so, in a market that uses just round numbers, 90, 95 million barrels a day, you withhold more than 10%, and you create a synthetic shortage, which was exactly their point. And then you layer in on top of that the fact that a global pandemic completely disrupts employment and supply chains, and on and on and on, and sort of everything that could complicate an already uh, tenuous oil supply and demand situation did. And it's really much more complicated than that, but let's just say it's really that simple for conversation. Natural gas, not hugely different. Natural gas in the United States is generally pretty cheap stuff. And even today, at about $4 per million cubic feet, or I'm sorry, $4 per thousand cubic feet or million BTUs, British thermal units, it's still a whole lot cheaper than it is in the rest of the world. The reason that natural gas, however, got so expensive is, to put it in simplest terms, Europe got a little carried away with their enthusiasm about renewable energy, and they sort of forgot that we're not quite ready for prime time on renewable, and they closed down all their gas storage in the UK. They stopped spending any money on drilling new natural gas resources. Russia has its own problems with supply, wasn't exporting as much, and all of a sudden, oh my gosh, we don't have enough gas. And so they started bidding the price up. China had a very different situation in which they decided, for reasons that we won't go into because I can't explain it, they just decided they didn't want to import any coal anymore from Australia, which was their main supplier, and put themselves in a really bad situation where they couldn't really replace the coal, and then had to pivot to natural gas. So we've got a situation now where East Asia and Europe are trying to outbid each other for cargoes of liquefied natural gas. And the result is that the prices for Asia and Europe are roughly 5 times what they are in the United States. And of course, when the cost of energy goes up, I mean, everything we do relies on energy. And so what a surprise that the cost of everything goes up. Then you layer in the supply chain issues and et cetera, and that's where we are today.
All right, that was super helpful, Art. I want to ask just a couple of quick clarifying questions. But you did a really good job, I think, of showing that it's very multifactorial, right? That what drives energy prices. There's just some things that are native to the market itself, like with oil. You said it started from a very low, depressed base because demand had just gotten so destroyed during 2020 with all the global shutdowns. But then there's a supply side to it, right, with the disruptions in the supply chains and some of the policy decisions that have been made about maybe in certain countries, either moving too fast to try to wean off fossil fuels, or China's extreme decision around getting off of Australian coal that then had unintended consequences. And then the third is there's just a geopolitical kind of wild card, which is sort of, what are the people that control supply? What are they thinking about doing to advance their own objectives? And OPEC's a great example of that. So let me ask you a question about OPEC. You said they were withholding 10 million barrels of production a day since basically 2020. Presumably, and correct anything I'm saying if I'm wrong here, presumably they were doing that because the price had dropped so low. And one brief moment, it actually went negative, right? Which is sort of a mind-blowing thing to contemplate. So my guess, and please correct me if this is wrong, is that OPEC, created this synthetic shortage, you said, because it basically wanted to make up for what it had lost during that period, right? So, okay, we made a lot less money off our oil for a while. Let's get the market tight here and let's, kind of make some of that back. A, is that true? And B, do you see them like why would they continue to keep supply out of the market now when demand has gotten so high again for oil?
Sure, those are really important questions, Adam. So the first thing is, if you ask OPEC, if you ask the Saudi oil minister, or if you ask the oil minister of Russia, of the Russian Federation, they'll tell you, no, it's not about price, it's about inventories. And so the world shut down, and oil storage around the world just, in a matter of a couple of weeks, it just went from normal to, oh my God, we don't even have any room to store oil. We got to that point in the United States, which is what drove oil prices negative. So you said, I can't even understand that. Well, I mean, you do, but some people can't. And the reason is that if you're out of storage, you have no place to put it. There's no demand, so you're willing to pay somebody to take it because you don't have any place to put it either. And so you're going to have a negative price because you're actually paying someone to take the oil off your hands. That's how we got negative one day in April of 2020. But the point
thank you for clarifying that. And all I want to say is exactly right. But what still blows my mind is that basically the world's most essential resource, the master resource, as you said, could ever get in the position where people would be paying others to take it away from them, but it can happen like it did.
Well, and 2020 was an absolutely extraordinary period in, I don't know if you could say global history, but certainly modern history, where the economies of the entire world closed pretty much simultaneously and stayed closed or at a very depressed level for weeks and weeks, if not months and months. So extraordinary things happen when you do extraordinary things. And that's what we saw. But the point is that if everybody's storage of oil is full to the gills, then price is going to be low. And so what do you do if you're OPEC and you control roughly a third of the world's oil supply? Well, you want to force people to work through their inventories. You want to force them to draw those inventories levels down to something approaching normal before you start putting your own production back onto the market. Now that, of course, has the effect of raising prices, but again, raising prices from negative $30 or $10 or something. I mean, it needs to go up because it's just not right at that price. So at some point, what happens, however, is that we become dependent on the price makers. And so they got affected by COVID and by all the shutdowns. And as you know, and maybe your listeners know, there's a huge amount of wealth inequality among OPEC. And so you've got countries like Saudi Arabia and Kuwait and the United Arab Emirates that are rich, super rich. And then you've got countries like Nigeria, like Angola, like Venezuela that are super poor. And so when production gets shut down and economies start hurting, countries like Nigeria and Angola, they just don't have the ability to just go back to reproducing where they were. Saudi Arabia, Kuwait, yeah, it takes money. I mean, to restart things takes money. And often it means drilling new wells and upgrading infrastructure. So right now, the truth of it is that OPEC Plus doesn't really have the capacity to just go right back to where they were. So there's a couple of swing producers like Saudi Arabia that could add a few million barrels a day to the market tomorrow, but that's about it. And could they maintain those levels is another question. And so markets know this. Markets understand this. Markets are you and me and our listeners. Our collective wisdom and knowledge goes into markets and price setting. So markets know that we're kind of screwed in a way. And of course, longer term, where's the oil going to come from in 5 years or 10 years? And we don't know, and maybe there won't be as much. And so that's the play that the market's making right now. The market's saying we need to boost price to get more people drilling so that we have more supply to offset the demand that has resurged. And that's again a complicated answer. It's about as simple as I can put it.
Okay, I appreciate that. All right, so I want to get to the long term in just a minute. Kind of about when I say long term, I mean the next couple of decades worth of what the supply outlook looks like. but let's focus just on the next year or two, right? I imagine most people around the world are hoping that, hey, we're gonna get back to some sort of equilibrium at some point that felt more like kind of pre-COVID levels at some point here. The supply chain, will come back fully online, provided we don't have another, major variant appear out of nowhere or some other global calamity. But so you're basically saying that right now the market's just trying to incentivize the development that's going to be needed to get enough supply back online to get to that equilibrium point. How long do you think that's going to take? I just mentioned everyone sort of has this hope that we're going to kind of get back to equilibrium. Do you share that hope, or do you fear that maybe something's different this time?
Well, we're dealing with the market that in the best of times is characterized by disequilibrium. And that's the whole reason you have storage, right? You have storage because there are seasons and times when you need more than you produce. So, for instance, in the Northern Hemisphere, in the United States and Canada, we like to, kind of drive our asses off in the summertime. And not so much in the winter. And of course, farmers like to get out in their fields and harvest and plant and all of that more or less in the spring and the summertime. So demand, if you will, in Northern Hemisphere countries is higher, always higher than supply in the summer and spring. And so we typically draw down what's in storage to fill the gap. And similarly, when our driving and our farming and everything else slows down because it gets cooler, then we start putting more into storage. So, that defines a disequilibrium situation. So I never see equilibrium in oil markets, and you know more about other markets than I do. Maybe maybe the same is true there as well. But I think your answer is your question is, when will things get back to something approaching what we knew before COVID? And the answer is probably never. That's my guess. And so, we have a situation right now with this latest COVID variant. Maybe this is a window into the future where not so many people are dying, but a lot of people are catching it. and so markets have tended to sort of minimize it. I mean, at first, markets were freaked out about Omicron. Now, not so much. But I think markets are. I never want to say markets are wrong, okay? Because markets are smarter than I am. But sometimes I think markets, because they do represent people, fall into the same errors that human behavior does. And what I see right now with this Omicron variant is, yeah, it's great that not as many people are dying, but the number of people that aren't working on a regular basis is huge. And if people aren't working and they're not spending money because they're not going to work, they're staying at home, then GDP is going to drop. And already Moody's is, they're calling, instead of 4% GDP growth in the first quarter, they're already saying, no, we think it's 2%. All these supply chain interruptions that boost prices because everybody wants stuff, they also slow the economic activity of countries and industries that are producing things. So even though it feels like, happy days are here again with high prices, things are not so good in terms of economic activity. And so, these are complexities that unfortunately, I deal with every day because people want to be optimistic and they want to say, oh my God, we're going to go back to 2011, 2012, oil's going to be $100, $110 a barrel, and everything's going to be great. And I say, well, maybe you're right, but that's not what I see. That's not what I see at all. I see a world that, assuming, if COVID just disappeared like former President Trump said it would. One day like a miracle, it's just gone. I think it'd take us 2 years to, as a global economy, to work through all of these disruptions that have been introduced by people, not being sick or people being sick and not working. And then you got the issue of, who the heck wants to go back to work in an office? And what happens to all that commercial office space that isn't being filled? The list goes on. So simple answer, things won't be as bad as they are right now. If the situation, if we can agree that it's bad with disruptions and uncertainty, but I don't see that we're ever going to go back to where we were in 2019, at least not for energy. I don't see it.
Okay, wow, it's a meaningful statement coming from a guy like you that follows the market so closely and has worked in it for so long. It's so fascinating because you listed off a number of what I would kind of call cross currents, right? So the supply crunch that we've been talking about, that obviously is inflationary from a price standpoint, right? But you just also mentioned a number of things that would reduce GDP growth, which would reduce the demand for oil, which in many ways would pull down the price. So it's going to be interesting to see what happens. And to your point, we may not get back to the normalcy that we had pre-COVID. From a price standpoint, just asking you to put on your price predictor's hat for a moment, do you see these sustained high prices for the foreseeable future here? Just trying to make it, relevant for the average viewer who's,
right,
putting gas in their car, buying heating oil, turning on the lights in their house.
Sure. So I think that I think we are currently at the upper limit of where prices for things like oil and natural gas and all of the products that come from them are going to be, and I'll be glad to explain why. But what's a lower price? A lower price. So let's say we're at $80 to $85 for oil right now. I don't expect it to stay there. I think we'll be, at 70 to 75. So, that's what, 15% lower than where we are right now. I think that, that is, if you want to use a cliche, perhaps the new normal. If you look at, at long-term energy prices and oil prices and adjust them for inflation, you find that something like $65 is kind of where it always is. And so if I say it's 70 to 75, I'm probably wrong by a couple of bucks, but we're not way out of line. It's just that we've gotten used to relatively low energy prices for the last 4 or 5 years, and that secular period of oversupply is over. That period of secular oversupply only happened because of the shale, the tight oil that got developed in the United States. Super high prices, 2011, 2012, 13, and part of 14 allowed all sorts of crazy things to happen. And one of them was drilling these shale wells and using all this expensive horizontal drilling and hydraulic fracturing and all of that. And the net result was the world's oil supply still hasn't grown since 2005, except for this wedge of mostly U.S. tight oil or shale. And that grew like 4.5 million barrels a day, which was a huge percent of global production, which caused oil prices to collapse in late 2014. And we had too much oil for 15, 16, 17, and most of 18 got up a little higher because of the U.S. pulling out of the Iran nuclear deal, and then went back down again. That's over. We've worked through the the flush period of another source of oil. We haven't used it all up yet, but the growth is pretty much gone. And so now we're back to where we were 15 years ago and saying, well, if demand keeps going up, where's the supply going to come from? And the answer is, we don't know. We just don't know. And the market knows that. And that's why prices are high. And prices got high 2006, 2007, 2008. Let's not forget that in 2008, just before the financial collapse, in adjusted real dollars, oil prices were never higher. They were like $165 a barrel in 2021 dollars. Why was that? Lots of reasons, but simple answer, we don't know where the next barrel is coming from, and demand's growing like crazy.
Okay, you said a lot of really important things there. I just want to quickly summarize and then jump off of. So one is that as the dust settles, you see prices coming down and stabilizing at the $70 to $75 range. And so you're basically saying we're going to have a new baseline going forward. And the main reason for that is what you just said, which is we had a, you used to call the shale revolution the oil industry's retirement party.
Right.
It was this kind of bonanza of late stage supply that we could unlock only because oil prices had gotten high enough to do so, and technologies, were enabling it. And we sprinted after it, and we took it out of the ground, and we had got to enjoy it, but we knew it was, at the time, it was finite. And you basically said that party is now kind of ending, right? We're still going to pull some shale out of the ground going forward, but the crazy growth rates that we saw are not going to come back. So I don't know if everybody watching this fully understands the dynamic of that, but I at least want them to get that point, right? Which is we had this sort of massive brief tailwind for about a decade or so from unlocking the U.S. shale patch, and we've gotten most of what we're going to get out of that. And as you just said, Art, we don't know where the next bonanza is going to come from, and maybe there isn't going to be one in the oil space. We just don't know at this point. So I want to pivot now to looking ahead, and by ahead I mean sort of next decade plus. In past conversations we've had, you have done, I think, a very good job of letting people know about the topic of peak oil, or at least peak cheap oil. I'll let you clarify however you want to refer to it as, but that we have in a global economy that really wants to continue growing at a certain clip, but the energy that it needs to grow, that it would require to grow at that clip, isn't necessarily going to be forthcoming from the Earth because of literally geological/planetary resources that we're beginning to bump into for the first time as a species here. So I guess just for the layperson, without going too deep into it in this conversation, Art, kind of how real is this, and how much are we going to feel this over the next decade? Are we going to see oil at some point above $100 a barrel again, maybe even higher, because of just too much competition for what remains?
That's the answer is I don't know, Adam. But and the piece that I don't know is whether or not the past is a reasonable guide to the present and the future. If it is, then yes, certainly. If the past is any guide to the future, then we will see oil above $100 again. We will very likely see oil at $150, $160, $170 again. But the part that's changed since all of that, again, remember I said 2008, we got to $160, $165 in today's prices. Well, if you think about what's happened since 2008 from a global fiscal perspective, the level of debt that the world has incurred since then is is just absolutely extraordinary. And we thought it was pretty extraordinary before 2020, and then we learned a new definition of extraordinary. So the global economy is absolutely under a debt load that not even you and I could have imagined probably before COVID. All right, that is an anchor. That is an absolute albatross around economic growth. And oil prices are the primary factor driving inflation. Now, you can talk to any economist, and they probably won't even mention oil. But I can show you a chart, and I will show you a chart in the deck that I'm giving you that shows I mean, it's not even a correlation. It's just, it shows you oil price and inflation rate. And you just can't find a better correlation. Now, we all know that correlations don't necessarily mean causation. But when you find a correlation that strong, you better believe that oil price is a major factor in that inflation. And so my point is that inflation at 7% or whatever we're at right now in the United States is another albatross around the neck of growth. Okay, so if oil price and inflation rate are linked, let's not say that necessarily oil causes high inflation. If they're linked and inflation gets any higher, then people are going to stop using services where they can. They're going to use their discretion. And one of the easiest things to be discreet about in your consumption is gasoline. You don't have a heck of a lot of choice about about heating your home. If you use fuel oil or natural gas or whatever, you don't have a lot of choice about, am I going to pay the electric bill? But you don't have to drive as much as you do currently. We can all cut down, especially since we're not going anywhere. So many people aren't, we're not commuting to work anymore. And so I think that now more than ever before, inflation creates a ceiling. It creates a ceiling to what level of economic activity is needed to grow. And so I'll show you another chart that correlates long-term inflation rate, oil demand and supply, and interest rates. And what you see is there are many, many reasons why demand gets destroyed, while people elect or can't afford to spend as much money. But inflation is always a factor. And so as long as we've got historically high inflation rates, and we're at a 30-year high, then it's reasonable that demand destruction for oil and other energy where it's possible is going to be a factor. The other thing I want to throw in here before you come back and ask me another question is that the investment community, the capital is simply not available for oil and natural gas and fossil energy the way it was 5 years ago. That the investment community has moved on. It has decided that renewables and hydrogen and I mean that new energy is the way of the future. And they made that decision for a lot of reasons. And principal one was that oil and gas were giving lousy returns for a long time. And so they said, okay, screw you guys. we don't want to listen to your lies anymore. We're looking elsewhere. Now, the energy sector is performing better than any sector right now in the U.S., or at least in terms of, S&P kind of sector ratings. But it's not exactly like investors are beating down the doors to write checks. They're writing checks for the ESG kinds of things. And so some investors are going to come back to energy, but a lot of them have had enough and don't believe the growth is there. So So with capital constraint, you said that high oil prices enabled the shale. Yeah, they sure did, but it was other people's money that really enabled the shales. And if the other people's money isn't there, then what are we going to use to pay for whatever the next thing is, if there is another thing following shale? And the answer is, it's hard to imagine how that will happen unless something, just some seismic event occurs and all of a sudden investors change their mind.
Okay, great. And Art, I really appreciate how you take a very complicated, very multifactorial topic and make it easy for people to follow. So thank you. Um, so from I want to get to, what potential areas of opportunity you think that today's investors might want to consider looking closely at to take advantage of what opportunity you might see being there. But before we get to those specifics, I just want to clarify a little bit more here on the macro side of things. So you're talking about, caps on inflation potential, debt and inflation potentially putting a cap on energy consumption or energy demand. And if that's true, and remember I said we're looking at it over the next decade plus, then that's a little bit of a scary world too, in the sense that it's sort of like a prolonged global recession, or maybe even depression if it got really bad. And kind of where I'm going with this is, unless ESG, alternative forms of energy can really ride to the rescue here and provide all the BTUs that we've been getting from fossil fuels and then some, right, to meet the increased growth that ideally the economies want. We're potentially looking at this world where either we want to grow and there's just not enough oil, or we can't pull it out of the can't pull enough fossil elements out of the ground as fast as we want, or we're kind of in this depressed, prolonged, recessed or depressed state where getting access to the cheapest BTUs becomes really important, right? Because price is such a limiting factor at that point in time. And so I guess two questions for you to tackle here. One is, for people that think, hey, alternatives are going to ride to the rescue, what kind of probability do you place on that versus the world continuing its addiction to fossil fuels, whether it wants to be addicted or not? And then secondly, just looking at what you were talking about over natural gas between China and Europe, is that a kind of a preview of what's coming potentially down the road in this future we're talking about, where the various countries are going to be competing much more intensely and maybe much more aggressively for the remaining cheap resources?
Right. So, as you can imagine, this opens the door to a potentially dark kind of view of the future. As a scientist, I consider myself neither an optimist or a pessimist. This is the data that I see, and this is where it's going. So, to address the easiest question, can renewables get themselves ready for prime time in time? The answer is categorically no, absolutely not. And I say that as a staunch environmentalist, conservationist, and one who would love to see a world in which we no longer use any fossil energy. But the physics of it simply do not work. They do not work. You cannot go from the world's most productive source of energy, which is to say oil, to a far less productive source of energy, which is solar and wind, and get the same output. It just can't be done. It's not a value judgment. It has nothing to do with which I like more. So just to give you an example, we can't compare the energy content of, let's just say, solar or wind with oil, because we burn oil. And because we burn it, we can actually measure the amount of calories, if you will, or joules. How much work can we get out of a barrel of oil? Well, we burn it and we turn a piston, or what. We can measure the work and say, okay, this is how much energy is contained in a barrel of oil. We can't do that with sun or wind because we can't burn it and it doesn't come in a barrel. What do you do with a barrel of sun? I don't know what to do. You sit in it, I guess. You get a tan. I don't know. But what we can do is we can measure something called power density, which is if we convert the natural gas, let's say, or the oil, or the solar, or the wind to electric power. Okay, then we can say from a unit of solar energy, how much electric power can I harness at one time? What's the density of that power supply? And so to think of this in terms of workers, all right, it takes roughly 1,100 wind workers to equal the work of one natural gas worker. It takes roughly 300 solar workers to equal the work of one natural gas worker. Again, we're talking about electric power generation. So if you're an employer and you have a choice of hiring one guy at whatever salary you pay him, or 1,100 guys and gals, sight unseen, what's your decision? Give me the one guy. I don't want 1,100 people on my payroll. That's nuts. Well, solar's better. You only need 265 of those for every natural gas worker. So if you want to get the same number of BTUs that you mentioned out of all those solar workers, then you need to multiply the number of solar panels by some, god-awful exponent to get to the same place as you are with natural gas right now. And if we're looking at what is the effect of our growth on the planet, overshoot, if you will, the species that we are causing to go extinct by eliminating their habitats, the forests and jungles that we're cutting down to make room for our need for food and etc., then renewables offer no solution whatsoever, because you actually have more land use to get the same juice from wind and solar that you do from oil and gas. And again, I'm not taking sides here. I'm very much on the renewable side. I'm just telling you the hard physics of it. You can't, they're not equivalent, and they never will be. And somebody out there is saying, oh, but wait a minute. What about technology? What about some technological innovation that we don't know about yet? And my answer is, if it ain't on the table, I'm not too interested in it, because we don't have 50 years or 100 years of the planet to wait for that thing to come along. Okay, we've got in my view, we have a climate situation which may not be, I may not be in the same emergency camp as some people, but I think it's pretty darn serious. And I don't think we have 20 years to wait for some as yet uninvented technology to somehow save our asses. I don't think we can do that. And so that's a hard thing to get your head around. But I assure you the physics are there. And without knowing much about physics, I can explain it in a simple way to people. Okay, but for now, you just have to take my word for it that I've done the work, and I can show you the slides, and your viewers will see the slides that show that it's just not an equivalent argument. The other thing that's very important to understand is that we have almost 8 billion people on the planet right now. And given the amount of renewable energy that we have today and allowing for huge growth, we will never be able to support 8 billion people on renewable energy. And so to be very, very conservative and generous, maybe only 1 or 1.5 billion fewer people are needed on the planet so that we can feed them all. Realistically, it's probably more like 4 billion. Okay, so now, we don't want to talk about people dying and how that occurs. Okay, let's not go that dark. But think about the amount of civil disruption that a few million people migrating out of North Africa and the Middle East into places like Europe and a little bit into the United States and Canada has created in the last 10 years. So you get, 10 million people or whatever coming out of Syria, and most of them going to Europe. And you look at the kind of social unrest and the economic dislocations that have occurred from that. You look at, what's happening in the United States with, make America great again and build a wall and all that kind of stuff. Okay, now instead of 10 million people, what if it's 500 million or a billion or 1.5 billion? I mean, can you imagine the amount of chaos that will exist in the world? And that's assuming we don't get into resource wars, which is what you were alluding to earlier. Now, I don't want to go down any of these dark pathways. I just want people to explore the avenues of my mind, which are not necessarily dark, just realistic. I mean, this is what happens when 10 million people need to find a new home. Say I'm way wrong. Say it's not 1 billion or 1.5 billion. Say it's only 500 million. Say it's only 250. What if it's only 100 million? A 10x level of emigration from what's already caused great dislocation economically, socially, religiously. I mean, this is going to be a mess. So we've got some really, really big issues here that nobody is talking about. I shouldn't say nobody. Few people are talking about because they're damn unpleasant. People want a box of hope, and I want it too. But our planet has limits, and we're right up against them right now. And so you want 5% GDP, you're gonna keep going down the same path. So back to where you want to go and started. For people that are looking for, if 5% or 4% or 3% GDP is the first box you check, then you need to create a new box, because that one's not going to exist anymore. Which doesn't mean you can't make money. It just means that party's over. That's my view. And if that party isn't over, then the planet is over, and that's a different kind of party to end. And maybe we won't be there for that, but my grandchildren will, and that bothers me. But nobody cares what I think. They're going to keep on using until they can't.
Well, I'll dispute that. I think a lot of people watching here care very much what your expert informed opinion is, Art. It's super important and really quite fascinating. Part of the topic. I feel badly that it took us this long to get to it, because I'm going to have to wrap up here in just a couple of minutes.
Sure.
But Art, let me, folks watching, let me ask you this: if you'd like me to have Art back on to do just a deep exploration, kind of in his outlook for the future, getting much deeper into the specifics of that type of future that he was kind of just giving us in broad brushstrokes there. Not to be dark, not to try to push one agenda or the other, sort of like you said, Art, I think people are just hungry for what the data suggests, right? So you spend a ton of time in this industry, the limitations and the strengths of the various different types of fuel sources that are out there, where the technologies are going, where the economic demand is heading. I would personally really like to see you connect more of those dots. I suspect other people would too. Folks, if you're watching and would like to, just let me know in the comments section below. If we get enough interest, I'll ask Art, and hopefully he'll be willing to come back on for that. I hate to ask this question because it sounds so mercenary after the topic you just talked about. But putting on, shorter term glasses now, looking out over the next, year or two, are there opportunities here based upon the current cross currents that you and I talked about earlier, where you think that there are pockets of opportunity that today's investors would, be wise to at least consider as they're looking for, opportunities to add into their portfolios? You talked about CapEx not really going into the oil space and some of this, fossil space as much as it was. Is that going to create shortages that are then going to have to play catch up? And are the people who are there as oil prices stabilize at higher rates, will they be more profitable than they were before? Don't want to put words in your mouth here, but are there elements of the oil, the energy sectors out there that you think are particularly promising right now?
Sure. It's easy to look at these oil and gas companies. All right, you can get on Google or Yahoo Finance or whatever, and just look at, on a quarterly basis, look at their CapEx. In other words, what are they spending to drill wells? That's 99% of an oil company or gas company's CapEx, and look at their cash flow from operations. Those are two numbers that that anybody can instantly pick out for any of these oil and gas companies, and just plot them or just write them down or whatever. And what you're going to find is every one of them has got a whole lot more cash flow than the amount of money they're spending right now. So every one of them, on that basis alone, is a sensible investment. You can refine that a little bit, and and I'm not an investment advisor, as you say, but you look at a company like Chevron, or you look at a company like Pioneer Natural Resources, or ConocoPhillips, and or EOG. Those are not the whole list, but those are just four that come to mind, who have outstanding financials, if you will. That they're in good positions. They've got relative to where they were a few years ago, fairly low debt loads. These are companies that, as long as we use oil and gas, are going to be profitable. And the companies that are in the Permian Basin in West Texas and eastern New Mexico, those companies are going to be making money on, as long as oil prices are in the $45 to $55 range. And I just told you that I don't see things going that low again. Now, you have to be careful. Inflation's an issue, and it affects the drilling costs and all of that. So that's not a fixed number. It's going to increase over time. The other thing I would say to look at is, and I don't want to take money away from the oil and gas sector, but all of this renewable energy and hydrogen and all, new energy, let's just call it that. Basically, the governments and their central banks of the world are guaranteeing their success. This is like Paul Volcker, raising the U.S. interest rates to 18% back in 1982 or whatever. How can you lose buying a U.S. Treasury bond when it's paying you 17 or 18%? You cannot lose. And so a lot of these new energy investments, simply as long as governments continue to throw their weight behind them with renewable energy credits, for instance. Don't be fooled. When you hear the propaganda that renewable energy is cheaper than oil and gas, first question is, ask which costs are excluded. and also ask how much fossil energy is needed to extract all the metals and to do all the transport and manufacture and distribution of those products. But that's a mouthful in itself. But the point is that for now, at least, when a renewable company puts in its bid to electric power providers for tomorrow, it usually bids zero. Okay, it doesn't usually get zero, because the way the supply and demand work out is it generally gets a positive number even though it bids zero. The reason it can bid zero is because of renewable energy credits. And what the heck are renewable energy? It's basically it's a carbon trade. And so companies like Google and Facebook and Amazon are putting billions of dollars into renewable energy credits that basically go to subsidize these $0 bids on tomorrow's electric power, so they can say, hey, we're net zero, even though they're burning, coal and all kinds of god awful things to, to run all their cloud farms and everything. It balances out to zero with the carbon credits. Now, carbon credits suck for the environment, but that's the game we're playing. So I'm just suggesting to you that there's a dimension here of a no lose bet, at least for now, as long as the incentives are guaranteed by governments and by central banks and by regs. And we don't care. I don't care about international agreements, because these are going on independent of Paris or Glasgow. I mean, these are things that are happening right now. So look into those.
All right, Art, thank you. Thank you for being so specific. And I know folks are going to want to follow up on both those major opportunities, both in the oil and gas players and in the new energy space. It's kind of like, it's almost like the new Fed put, the new Fed administration put, if you're investing in new energy. All right, Art, well, look, as we wrap up here, thank you so much. It's been a great conversation. For folks that have really enjoyed hearing your insights and would like to follow you and your work, where should they go?
They should go to artberman.com. They should go to at aeberman12 on Twitter. And if that doesn't work for you, then I can't help you. I'm very prolific on both. There's lots of free content on my website, and I'm on Twitter more day than my wife would like to see me on it. So you'll get the the full flow of my free cash, my free brain flow on Twitter.
Great. Well, as somebody who follows it daily, you do a heroic amount of work there and publish just a ton of amazing charts. So folks, if you like data, follow Art on Twitter. All right, folks, well, look, as we wrap up here, if you have enjoyed this interview, would like to see more interviews with great minds like Art, just take a second and support this channel by hitting the like button and then clicking the subscribe button below if you haven't already, as well as that little bell icon right next to it. And if you'd like help in putting some of the investment ideas that Art mentioned into practice, if you're not an experienced investor in the energy space, feel free just to talk for free to one of Wealthion's endorsed financial advisors, and you can set up a free call with them if you go to Wealthion.com. All right, everybody. Thanks so much for joining. Art, thanks so much again for a great conversation here. Can't wait to see you next time.
Always a pleasure, Adam. Thank you.